In the last episode, we discussed and estimated our after-tax cost of debt, along with the expected weight of our capital structure, which leaves our cost of equity as the final variable needed to determine our weighted average cost of capital, which in turn is the interest rate we'll use in our discounted cash flow analysis. So we'll approach this in the same way. First discussing what our cost of equity conceptually represents, and similar to our cost of debt. At a high level, the concept is relatively straightforward. Our cost of equity is the return investors require to compensate them for the risk of owning the company's stock, or for a private entity, the return the partners or owners require to invest in the company. And just like the cost of debt, this is a forward-looking measure. We aren't concerned with the historical returns to equity. Instead, we look to the future. We're asking ourselves, what rate of return do we require to invest in this company, given its risk profile and other investment opportunities available to us? Now, determining the cost of equity for a business is generally a more complex and difficult analysis than determining the cost of debt. And in almost all cases, the cost of equity will be higher than the cost of debt. Both of these statements are true for several reasons. 1. Debt has contractual required payments determined by the stated interest rate on the debt. On the other hand, equity holders have no guarantee to payments by the company. They can receive payments in the form of dividends, or the company can return capital to equity shareholders by repurchasing shares. But a company is typically under no obligation to pay out dividends or repurchase shares. It's a decision made at the discretion of the board. There are preferred share classes where dividends are potentially required, and those instruments can begin to become very debt-like. In fact, in some cases, we'd account for them under US GAAP as debt on the balance sheet. But we won't get into those complex situations here. For our purposes, we'll assume we're discussing common stock, which typically has no contractual right to dividend payments. Additionally, under the corporate laws of nearly every developed nation, and certainly in the United States, debt holders have a higher claim on the company's assets in bankruptcy than equity holders. Indeed, in most cases, common equity holders have the lowest claim on a company's assets in bankruptcy. So if a company does run into trouble and needs to liquidate, debt holders are paid out well ahead of common equity holders, who receive only what's left after paying out every other claimant. This makes holding debt less risky than holding equity, which means the return we require on our equity holdings will be higher than the return required on debt holdings. Essentially, if we hold equity in a company, we'll take part in any upside in the growth of the business. A debt holder's payments are fixed no matter how successful the underlying business, whereas an equity holder's value will grow as the overall valuation of the business grows. But as an equity holder, we also accept more risk to the downside. And because of this, we will require a greater return on the investment. So how do we go about quantifying how much return an equity investor requires for bearing that additional risk? This is where things can get quite tricky, especially for a private enterprise. And I've said this a few times now, but this isn't a corporate strategy or asset pricing series, so we want to remain focused on applying time value of money concepts. So we'll cover this only at a very high level, just enough to finally determine our weighted average cost of capital. So the traditional way of calculating a cost of equity is through something called the Capital Asset Pricing Model, or CAPM for short. It's not the only model out there, but it is the most common. Under the Capital Asset Pricing Model, the formula to determine the required return on equity is the risk-free rate plus the market risk premium, calculated as the expected overall market return less the risk-free rate, multiplied by the company's beta. The risk-free rate here is generally proxied by looking to long-term government bonds. A common example is the current yield on 10-year US Treasury bonds. we want to look to long-term bonds because in our discounted cash flow model, we're attempting to discount very long-term cash flows. Let's assume for our analysis that the current yield on 10-year US Treasury bonds is 4.22%. This will be the risk-free rate in our analysis. Then for the market risk premium, we need to determine the extra return that investors require for investing in the stock market over risk-free assets like Treasuries, to compensate them for systematic risk. Historically, equities have earned more than Treasury securities because they're riskier, and the difference between those two returns is what we call the equity risk premium. A common approach is to estimate the equity risk premium directly using long-run historical data from broad market indexes, comparing realized equity returns to realized risk-free returns over the same period. We could use different timelines, indexes, or models, and this analysis can get quite complex. But let's assume for our purposes that we'll use an equity risk premium of 5.28%. This represents the additional return investors have historically required, on average, for bearing the systematic risk of equity investing above the return on a risk-free asset. And that brings us to our final and most important input, the equity beta, which measures how sensitive a company's stock returns are to movements in the overall market. A beta of 1 means the stock's returns tend to move in line with the market on average. When the market rises 1%, we'd expect the stock to rise about 1% as well. A beta greater than 1 means the stock's returns are more sensitive to market movements than average. And a beta less than 1 means they're less sensitive. The key word here is sensitive. Beta isn't saying the stock and the market move together day by day. It's measuring how much the stock's returns tend to amplify or dampen broader market movements over time. What beta is really capturing is systematic risk, which is the risk that cannot be diversified away by holding a large number of securities. Investors can eliminate company-specific risk by diversifying. If one company in their portfolio has a bad quarter, others may have a good one. But they cannot diversify away market-wide risk, because when the overall market falls, most stocks fall with it to varying degrees. Beta quantifies that varying degree, which is why it's the right measure of risk for an investor who holds a diversified portfolio. To calculate beta, we'd have to dive into regression math. It's a figure determined statistically using historical return data. But the good news for us is if we're a public company, in many cases this has been calculated for us. For instance, if we look at General Electric stock on Yahoo Finance, we can see they provide the historical 5-year monthly beta of 1.43. Now we do run into complications if we're a private company. There will be no quoted prices for our shares, and thus no published beta. The underlying idea is identical. We're attempting to determine the return required by investors given the risk of our business, but we'll have no quoted data to use. So the typical process is to find comparable public companies in the same industry with similar operating risk. Since they're public, their betas will be published. But we need to remove the effect of leverage from the comparable companies. First, we would isolate the business risk by removing the effect of that leverage. This will give us an unlevered beta, and then we can apply our target capital structure to estimate what the equity risk would look like under our ownership and capital structure. So again, this isn't a capital asset pricing model series, and I don't want to get too lost in the weeds here. We're going through all of this analysis to estimate an interest rate to use in our discounted cash flow analysis. So to ensure we're keeping the focus on time value of money concepts, let's simply assume we or another expert on our finance team has worked through all of this analysis and determined that our levered beta is 1.2. With that information, we're ready to determine our cost of equity. Recall we estimated a risk-free rate of 4.22% and an equity risk premium of 5.28%. So based on the capital asset pricing model, we'd calculate our cost of equity as 4.22% plus 1.2 multiplied by 5.28%, which comes out to 10.556%. And this is the cost of equity we'll use to determine our weighted average cost of capital.